Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Tom Bratkovich, senior vice president at Wilshire, with $1 trillion of assets under administration, to discuss private market investments for defined contribution plans. Tom, it's great to meet with you. Welcome to Trade Talks.
Hey, thanks for having me, Jill. Really appreciate it.
All right, you got it. And why are defined contribution plans considering private equity, private real estate assets, and private credit now? What has changed?
Yeah, I think, the discussion around alts for DC plans has become far more real for us over the past couple of years. We partnered with Macquarie and Nasdaq to build out and manage alternative solutions directly in this space. And so, we've got a couple graphics maybe that might help explain and answer this question. So if you want to flip to that first slide there, the latest numbers, show that there's about 7 trillion of AUM in DC plans. And if you look at the top two graphs there, you'll see that, DC plans have really started to outpace DB plans quite significantly in terms of their AUM and the number of participants that are actually in these different types of plans. And the performance, though, of DB plans has actually outstripped that of DC plans over a compounded recent 10-year period. So you can kind of see that in the lower left-hand graphic here. DC plans are starting to catch up, which is interesting. Their asset mix has really improved, I would say, especially over the last 5 or 10 years. So they have less reliance on company stock and corporate plans. They've got heavier reliance on target date offerings, et cetera. They use default options now, so that helps minimize the amount of cash that's held by the participants actually. And they've adopted a lot of lower cost index products. So this has all helped their performance improve over time. However, the lens that we sort of look at this space is through the institutional view, if you will. So we spent decades serving our institutional clients and investors. So these are very large pension plans, insurance companies, sovereign wealth funds, et cetera. Very sophisticated investors, and they've really directly benefited by having private markets in their portfolio. And you can kind of see this on the lower right-hand graphic on the slide. This is an ongoing survey from Preqin of over 4,000 institutional limited partners and investors, and their allocations to private market have pretty consistently held at about 20%. So they figured out the benefits of private markets and alts. And, these are, as I said, some of the most sophisticated investors in the world. So we believe in democratizing, this space and really, the thesis of bringing these kinds of investments to the rest of the investment world.
So Tom, I guess the question is, why now?
Yeah, well, so, we've seen corporate pension plans kind of lead the charge in this space. They've started to provide their DC plan participants exposure mostly to private real assets through specialized structures and time-dated funds or managed asset allocation plans. But something happened this past summer. The Department of Labor produced some guidance to asset managers around how to structure their private investment offerings to make them ERISA compliant and available to DC plans. So you have to meet several criteria, and it can be complex, but in particular, the offering needs to be part of a larger managed asset allocation structure, like a time-dated fund, for example. The key is to make sure that participants cannot excessively load up on private markets or any one specialized asset class in an unbalanced manner. But, it's great news for the space. The fact that the DOL and, the SEC have kind of, gotten together, provided a lot of guidance in this area recently. And, we think that's really a game changer. And, that really helps sort of unlock, these structures for DC plans.
So assuming that the structural requirements can be satisfied, why would anyone want to include private market investments in their DC plan offerings?
Yeah, well, maybe we can hop to the next graphic here, but there's really two overarching reasons. The first and foremost is performance. So private markets have historically outperformed their public counterparts. And really importantly, the top quartile managers within the private markets have vastly outperformed the public markets and the comparables and the benchmarks. And that's really important. Performance gains are tremendous. They've been persistent, over the last couple decades that we have data. And we think that's really important. The second main reason is diversification. So private markets, they tap a much more diversified segment of the economy than the public markets do, which is kind of a little known fact. But there's tens and tens of thousands of, private companies and different structures within, debt and equity, that you can invest in within the private markets and these private companies. So the correlation benefits of diversifying into these private areas really stack up, and it really helps with portfolio risk management. And large institutional investors have figured this out, over the last couple decades, as we just talked about. But we think that that's really important in terms of why people would want to tap this, perhaps for DC plans.
What is required to practically construct a private markets offering for a DC plan?
Yeah, well, maybe again we could hop to the next slide here. We've got just a few thoughts on that, but first and really important are the things on the right, which is all about portfolio construction. It's important from a risk mitigation perspective, value creation, et cetera, to actually diversify along these areas that we talk about here, which is sector and geography and strategy. There's many different sub strategies, lots of investment types, various places you can invest in the private markets. But it's difficult. You really have to pay much greater attention to sourcing and screening and diligencing these managers. There's tens of thousands of private markets managers, as shown kind of over there on the left. And so, it really takes kind of decades of dedication, career level dedication, over time, for folks that operate in this space to know, where do you find alpha? What are good risk, reducing areas for your portfolio? How do you stack these things together to make sure that you're not over allocated in one specific area? And how do you find sort of the best manager? So, that's something that we've been doing here at Wilshire for a long, long time. And, we've learned sort of, nimbleness and flexibility in cycles. I think a lot of us, here have now seen 3 different cycles, the tech bubble bursting, the GFC, COVID, and in each of them, these various different stuff strategies, they perform slightly differently as you're kind of going into and out of these cycles. And, that's a knowledge base that's hard earned, over kind of career level, participation and decades of spending time in these different areas.
What is specific to defined contribution plans?
Okay, well, maybe just one more slide on this, but we're focused on with our partners and solving some of the issues that past and current attempts in the DC space really haven't been able to sort of tackle or solve for various different reasons. But there's various different things here that can be complex, but if you have the right folks, the right team partners, you can address these and, actually craft solutions that work, for the vast majority of DC plans. So I would categorize these kind of into, 2 main categories. So we're working on next generation structures, I would say, with our partners at Macquarie and Nasdaq. The first area is really around DC plan compliance and what I would call ease of use issues. So these are things like 1099 tax reporting, as opposed to what you typically see in the private markets, which is K1 tax reporting, which can be pretty complex. But we've got simplified 1099 tax reporting available now for these kinds of structures. Also, no carry or performance fees. That's sort of another area. They all fit into, how do you actually bring these things compliant with DC plans? The other primary thing is liquidity. So past attempts in this area have not really been that successful in what we call decoupling the underlying long-term asset base of private markets investing with very short-term buy and sell demand. And if you can do that, if you can decouple those 2 things, the demand to buy and sell, from these long-term assets, then you can minimize the amount of cash that you hold in these portfolios, and then you can minimize cash drag on performance. And we spend a lot of time thinking about how to do that. That cash drag can be detrimental unless you've got some really advanced structures and some deep thinking in terms of how to, minimize the performance hit that you take, relative to holding cash on your balance sheet.
And Tom, to wrap up here, do you think that this segment is going to finally take off?
Yeah, look, people have been trying to provide private markets access to DC plans for decades. So this is not a new quest, if you will. But we think some things have really changed, and we're very excited about that. We finally have SEC approved structures. We've got guidance on how to implement now from the DOL. We've got examples from the corporate pension world, that have been, crafted as starting points. And there's things out there, that have, been worked mostly in the last decade around interval funds that provide some templates that we can advance on and improve upon. So we think the industry is ready to be transformed. It may take years, but we see building interest and acceleration in this space. And, we're really pushing hard on it and pretty excited to see if we can unlock this for the vast majority of DC plan participants.
All right, Tom, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.